Hello there, welcome to another video in this Forex trading training series. My name's Sam Morton. This video is brought to you by forexminute.com and this is video number 20, the Stochastic. The Stochastic is my favourite technical indicator to use when trading with technical analysis. I find it very reliable and it's very good to use as a confirmation signal or as part of your Forex market analysis. The stochastic signals when markets are potentially overbought or oversold, and it's used to identify potential price reversals, not so much trend reversals, an uptrend becoming a downtrend becoming an uptrend, but reversals of price, such as a pullback reversing to a push reversing to a pullback, price reversing off resistance or off support. And as mentioned, it should be used as confirmation to price action analysis. The stochastic settings I'll be using in this video are the default standard settings of 14, 3 and 1. This is a daily chart of the US dollar, Swiss franc, and on this chart I have the stochastic indicator. It's this indicator at the bottom of the screen. You'll notice the indicator has two lines that move up and down. When these two lines are in this white area, which is above the 80, the indicator has a gauge from 0 to 100. So when these lines are above the 80 in this white area, that is a signal that markets are currently overbought and price could move on the downside. When these two lines are in this bottom white area, under 20 on the gauge, that can act as a signal that the market is oversold and price could move on the upside. So price is clearly downtrending on the US dollar, Swiss franc. And in this video, I'm just going to show you how to use the stochastic as a confirmation to price action. So if we're looking to join this trend, it may be that we've seen this push on the downside, we have this pullback, so we have a clear engulfing candle, and at the close of this engulfing candle, both of our lines on the stochastic are showing overbought, that price could potentially fall on the downside, and that's what we want. And then price does fall on the downside. If we zoom in a bit, you should see this more clearly. So here's the pullback, we have an engulfing candle, stochastic agrees, and price falls on the downside. It's interesting to note that as our stochastic moves from this 80 to 100 area down, price moves down also. So let's carry on with this downtrend. There's a nice signal here. We have another pullback, a big pin bar here, and our stochastic agrees that markets are overbought and price could fall on the downside, and soon after price does. This is today's candle. If we join some highs on this trend, we can create a trend resistance. Like so. You'll notice we get a pin bar and an engulfing candle on this trend resistance. Let's zoom in. Right here, our stochastic agrees that markets are overbought. We have two signals here to go short, and it looks like price is now going for another push on the downside, and this downtrend is continuing. So that's an overview of how to use the stochastic as a confirmation to price action analysis. There could be many times that we see a signal to go short, to go long using price action, such as an engulfing candle or pin bar on a pullback, but our stochastic won't agree. And more often than not, those trades turn out to be losers. If we use the stochastic as a confirmation to our trading, we can have more profitable trades. In summary, the stochastic signals when markets are potentially overbought or oversold, and the stochastic should be used as a confirmation or as part of market analysis. In our next video, I will give an overview of how to use the RSI and ADX indicators. Please check out our website forexminute.com for market analysis, training material, broker reviews and more.